Right. All right, but we begin this hour with some positive news about the economy. The new GDP numbers show growth for the first time in 2 quarters.
Many people celebrating this news now. The rebound is temporarily easing recession concerns, even with continued high inflation. The Commerce Department is reporting that the U.S. gross domestic product rose by an annualized rate of 2.6% from July to September. That's a turnaround from 2 straight quarters of decline between January and June. Meanwhile, first-time jobless claims remained near record lows. The Labor Department reports 217,000 Americans applied for unemployment benefits last week. That's only 3,000 more than the previous week.
But mortgage rates have reached their highest levels in 20 years. Freddie Mac is reporting the average rate of the 30-year fixed mortgage topped 7% this week for the first time since 2002. Joining us now to break all this down is Lori Bettinger. She's the president of BancAlliance. She's also the former director of the Treasury Department's Troubled Asset Relief Program. Lori, welcome. Always great to have you with us. So, good news about the economy, right? The economy accelerated last quarter. What exactly fueled this?
Good news indeed, at least at the headline level. We talk so much about, like, are we in a recession? What defines a recession? The standard way we look at it is 2 quarters in a row of GDP, shrinking, negative growth. And so the good news is, right, the economy grew. We saw an increase in GDP. But when you look at the numbers, the main driver of growth was actually the trade balance, which isn't something that affects most of us in our day-to-day lives. It essentially means that the amount we exported, we sent abroad, was more than the amount we imported, or goods and services that we sort of brought into the country. So, it's a great thing. But then when we look at some of the other factors that probably affect us more as households, there I'd say the message is a little more mixed.
Mm-hmm. Lori, the Fed has been pushing up interest rates in an effort to actually do the opposite, slow down the economy. Right. So how does this new economic news affect recession predictions? And how significant is the latest GDP report in terms of what it says about the overall state of our economy?
It's a good question because, I mentioned, this sort of trade balance. I mean, that's a component that can swing a lot within the GDP. But there are other components like, for example, the housing sector, which is really down and, creating a drag. It's going the other way. And consumer spending, we're seeing that really start to slow. We're seeing business spending, sort of business investment also start to slow, which I think if you're a policymaker is a good sign, right? Because they want to see people buying a little less, spending a little less, taking off pressure on some of those prices to keep going up. So I think from that perspective, it's probably good. But I think when you sit and look at what does that mean for the economy overall, you have to see the warning signs, right? Even in the first quarter GDP, we saw consumer spending really strong, but people are pulling back. I think inflation's biting everyone, and we're still seeing stronger spending on services like restaurants, vacations, but people are buying less goods, maybe fewer cars, laundry machines, those sorts of items.
Right. And to your point that there are so many different indicators that we're watching here. So in addition to the growing economy, we also learned today that initial unemployment claims remain historically low, even as mortgage rates, as we said earlier, continue to skyrocket. So, all of these indicators, some seem contradictory. So what can we expect to see from the Federal Reserve next week? Could some or all of these reports have an impact?
I agree. I mean, it feels like for many months we get, a good set of news, then a worse set of news, then a good set of news, like good job market numbers makes everyone nervous about inflation. Right. So it's hard to tease all of this out. But I don't see a change in this sort of, increase in interest rates because while I think we're starting to see the economy cool and signs of that, look at what you just mentioned, the jobless claims. It's still a strong job market. Maybe claims went up slightly, but on the whole, I think we're seeing companies hold on to the employees they have, which is, great for all of us employees. And, maybe we're adding fewer jobs, but I don't think that the job market is really cooling in any material way. So to the extent you talk about increases in wages causing inflation, that feels like it's continuing. And I think, again, this question is you talk about consumer sentiment and how are people feeling and everyone's nervous, but then you look at the spending and it's holding up. Maybe people are buying different things. And the question is, how long can that be the case? How much savings do people have? And I think as long as you have a pretty strong job market, people are going to feel confident making these purchases. So a lot going on right now, as always.
For sure. Well, Lori, always appreciate you coming on and making it make sense for all of us. Lori Bettinger, thanks.
Thank you.